I enjoy coming to work every day knowing that clients are depending on me to guide them through whatever financial needs they have.
Every client we have is different. And so it's really about finding out what's really the most important thing per client.
With financial planning, everything is interconnected. So a comprehensive plan means that you're taking care of income needs now, income needs in the intermediate term, and income needs long term. We'll do an asset cycle portfolio. We'll do a risk-alize test. We'll do a life insurance audit or a life insurance review.
And so when we build a deep relationship with our clients, then we can take a step back and then we can look at different options to help them specifically get to their goals. One of the things I feel our job is as advisors is to introduce strategies to clients that maybe they did not know that they were out there. But it's our idea, our job to come out and say, have you ever thought about this?
And the planning it's not always about income, but a lot of it is also about the legacy. So the element of family is very important to us, and it's important to our clients.
Hello, my name is Steve Jablonski, and I'm the host of Financially Speaking with Jeff Bush. Great show today, Jeff. We're going to talk about retirement, the yesteryear versus today. There's a lot of differences, but there's a lot of similarities. And we do have some really specific slides on accumulation, distribution phases, sources of income in retirement, the right investment balance, and then we'll finish up with the asset cycle portfolio. But to start off, I'd like to talk a little higher level about some of the changes. And we look at people today retire to something instead of from something. We look at longevity, we look at the health of Social Security, and not your father's stock market's another one. So with that said, Jeff?
Yeah. Well, hello, Steve. Welcome to the show. It sounds like an exciting show. I can't wait to see it. I've been around for so long that I'm sort of on the front side of the way retirement used to be, having been in the business now for 28 years. It's hard to believe it's been that long, but we've seen a lot of changes. But you are absolutely correct in that retirement today is not the same as it was just a generation ago. And I think as things have evolved, retirement just has a different look. And we always like to say in the office, this is not your father's retirement. Just like we like to say, this is not your father's stock market. And that little analogy just means that, things are different. The world is different. The markets are different. And we just kind of want to touch on that today. And along the way, we're going to give some ideas on, what people should be looking at as they approach retirement in today's world.
And so if we look at the stock market from, say, 1980 to today, and you get that 20-year point in between, what's it look like?
Well, from 1980, you're talking about like from 1980 to 2000,
yes.
And then 2000 to 2000.
Yes.
So it's from 1980 to 2000. That's what we call your father's stock market. And the reason why we call it that is the market was generally in an upswing. And we have do you have that slide?
I do
today?
Not today.
Okay. Yeah. Yes. So between 1980 and 2000. The market was pretty much on an upswing. Yep. There were some minor blips in there, like for example, what they call Black Monday, which was in 1987. But for the most part, the market was on a very, very steady increase. And by the way, some people that are going to watch this show are going to remember Black Monday. And do you know, Steve, that in 1987, the year of Black Monday, when the market dropped like some ridiculous amount, it was like 20% in one day. I don't know if it was exactly that, but it was a lot. Do you know that in 1987, for the whole year that the market finished in positive
It was
territory.
positive. I actually did know that, but yes,
Yeah.
most people will not know that.
Yeah. So
Yep.
anyway, yeah. So that's a nice little historical perspective.
But then we go from 2000 to today.
Yeah, it's very different. Something happened in 2000, and remember Y2K?
Yep. You got your generator, right?
Yeah, you had the generator, the bottled water, all the canned food, because we were all worried about things coming to a screeching halt when the clock turned from 1999 to the year 2000. I remember that particular New Year's Day because my wife had to work because she was working in an IT role, and she had to be available to troubleshoot any problems that may have come about because of the Y2K. So I was home with at the time, 3 children. So we celebrated the New Year without her because she was working because they were all worried that things were going to happen.
Yeah.
But anyway, nothing did happen except in the stock market. The stock market has been dramatically different in the period of time since Y2K, and we've had a lot of events, world events.
And we had the lost decade in there.
Well, yeah, it created the lost decade. So we had the tech bubble. We started with the tech bubble. Then we had the attacks of 9/11, the terrorist attacks, and then we went through some small period of growth up to 2008 when we had the financial crisis when the market went way down, and then, as you said, the lost decade. So when we refer to the lost decade, we're talking about the period of time between 2000 and 2010 when the market essentially didn't do anything. It was flat for a 10-year period of time. So then we get into the next decade where we just had another period of volatility. We had volatility through 2015 and 2018. We had a lot. We had the budget crisis. That we had a lot of stress. We had the election of 2016, and so on and so on. I mean, we could, it's like a history lesson here. And then we had the financial crisis that we are, experiencing now, which was kind of as a result of the pandemic, the COVID crisis of 2020. So yeah, it's been an interesting period of time in the market for the last 20-some years.
And we look at retirement itself, and we go back, the prior generation, and retirement period was much shorter, and it was like people retired from something, not to something.
Yeah, so you would typically retire when you're 65 was the retirement age. That was back many years ago. That was when you could collect your Social Security benefit at age 65, and that's what everybody worked for. But life expectancy was different. So if you looked at the world, let's pick like 1980 as a year. So the retirement age was 65, and the life expectancy of somebody that was born or they turned 65, their life expectancy was probably maybe 85, early 80s to 85, let's say. So they had maybe 20 years in retirement, if you're lucky.
Yep.
If you're lucky.
Yep.
Yeah. And now some people retire sooner, some people retire later, they make lifestyle decisions. But like you said, they're retiring to something. It's a lifestyle.
Yep.
It's a lifestyle decision.
And when we look at life expectancy, which you touched on, but then we look at when the Social Security system came out, and it was old age insurance, and that has changed
Yeah, it's changed dramatically. So the Social Security system, which has been with us for since 1935, so it's been almost 90 years. That's hard to believe, but yeah, that was called old age insurance or old age and disability insurance. And back then, the life expectancy was only like 67.
Yeah.
So people, so the Social Security system was like, well, how long could people possibly collect this benefit?
Yep.
If they're retiring at 65 and the life expectancy is 67. And you can see why we're having problems.
Yep.
Because now if people retire, and full retirement age, by the way, is pushed up to age 67. So if you were born in 1960 or later, the full retirement age is 67. If you were born prior to 1960, let's say you were born between 1954 and 1960, then your retirement age is 66 and a few months.
Sure.
But once you're born after the year 1960, your full retirement age is 67. So they've moved that a full 2 years to try to save the Social Security system, and they're going to have to do other things. When I say they, I mean the powers that be down in Washington, our government, our federal government, is going to have to do something to save our Social Security system, or they're going to run out of money in 1933, I think.
233.
2033.
2033, yeah, and it's supposed to be only
20.
78% solvent at that point, or the latest.
Yeah. So something's going to have to give. Either they're going to have to raise the taxes, they're going to have to raise the Social Security age, you're going to have to cut benefits, they're going to have to do something to keep that system going.
Now, as we get into some specific slides here, let's go into the accumulation phase. Tell us a little bit about that.
Well, the accumulation phase of your working life is when you're saving and you're investing for retirement. So the best way to do that, Steve, is to do it through your employer, through payroll deduction. A 401k would be a good example. Take money out of your paycheck every pay period. It goes into a retirement account. Oftentimes the employer matches it, and that's really how wealth was built for this generation of workers.
And at that point in the accumulation, a lot of people just want the asset allocation.
Yeah, because the risk profile typically of someone that is in the accumulation phase, you're looking for growth.
Yep.
You're looking for growth as opposed to looking for income. So these asset allocation models are good in that they target a specific retirement date, and they adjust the allocation accordingly. We say asset allocation, we're talking about the allocation primarily between stocks and bonds.
And the primary risk there is just premature death, job losses, divorce, disability, which are different than when we get into the distribution phase.
Yeah, so the risk that you're taking in the early part is the risk of dying. Usually, if you die, you have a young family.
Yeah.
You leave a spouse, you're leaving children behind, probably a nice big mortgage, and a lot of debt. Maybe debt from going to college, or a lot of different things that are affecting a person during their working years, which you have to plan for, through insurance or through work-related benefits. These things are protected. And then once you get into retirement, or what we call the distribution phase, then the risks that you're taking at that point are a little different.
And it's like climbing the mountain.
It's like climbing Mount Everest.
Yep.
It's the climb down the mountain is very different than the climb up the mountain. So when you're climbing down the mountain, you got to adjust, and you got to adjust to things like stock market volatility, inflation, dealing with your own longevity,
Yep.
the longevity of your spouse, and now throw in there caring for an aging parent. Because when you think about it, you retire, you're in your 60s, you might have a parent that you're caring for that's in their 80s or 90s. And we see that a lot.
And there's also, with the distribution phase, you have to start thinking about your different. You're not going to get your health care from your employer. You got to get the retirement income. You got the estate planning. Taxes are different.
Yeah, it's a whole different ballgame, and that's why the planning that we do is so important, because we address all those things. But when you're so here's an example, Steve. Let's say that you want to retire when you're 62. Mm-hmm. You can get your Social Security benefit on a reduced basis, but once you leave your employer, you're no longer eligible for employer health insurance in the vast majority of cases. So what do? Because you're not eligible for Medicare until you're 65. So you got to bridge that gap between 62 and 65. So you have to look for health insurance often on the open market. It can be expensive, especially if you have some health issues. So there's a lot of things to consider when you're contemplating retirement.
And so when we look at the sources, so if we go back a generation before and we go to today, what's the difference?
Well, the difference is, quite simply, in the retirement of yesteryear, most people were reliant on a company pension. Okay, 60% of people that retired in a generation ago received a company pension, versus today, a smaller amount receive a pension.
Yep.
I don't know. You might have the statistics there.
People that start jobs now, it's less than 10%.
It's less than 10%. Yeah, it's a small number.
Yeah, it's a small number.
Yeah. So what does that mean? Well, it means you have to take control of your own stream of income when you retire. You're responsible for that.
And that's like the three-legged stool. How that's really changed.
Yeah, so the three-legged stool is, your sources of retirement. So, the three legs are, you're going to get a Social Security benefit, you're getting a pension, and then you're getting income from retirement savings. Well, in today's world, you're relying more on retirement savings, and the pension might not even be there. It might be a two-legged stool.
It can be.
Yeah. So, and we all know how difficult that is to balance.
It's a tough one.
On a two-legged stool. So it's a lot different. So it's difficult. There's a lot of difficulty, and I think the other important thing to note here, Steve, is that when you look at retirement of yesteryear, they did not worry about what the stock market was going to do. There was very little concern about stock market volatility. Today's retiree is very different. You're very concerned about stock market volatility because it affects your 401k, it affects other investments that you're using to generate income. It's a very different world. And of course, that coupled with the fact that the stock market is so much more volatile now than it was a generation ago. We see a lot more volatility. It really it's tricky.
Yep. And we get into the balance of investments and finding the correct investments with there's trade-offs. So what's that look like?
There's always going to be trade-offs. So if we look at this graph that we're going to put up, finding the right balance in your portfolio. So you can invest in three different ways. You can invest for growth, you can invest for liquidity, or you can invest for safety. But you can't You can't achieve all three at one time. That investment simply does not exist
Right.
where those three circles meet. So some examples of growth would be, and we have it up here on the chart. You have bank CDs, you have fixed annuities, you have fixed index annuities, and you have bonds. What else would you have for growth?
The growth is up.
You have managed accounts.
Yep.
You have stocks, variable annuities, ETFs, which are exchange traded funds, and you have mutual funds. So some of those, you have can give you safety. Some of them can give you liquidity, depending on what you're shooting for.
Yep.
I think the main takeaway of this graph, Steve, is that in any portfolio, you need diversification. You need a little bit of all these things so that you can meet all of your financial objectives, whether it's income, whether it's growth, whether it's safety. You need some diversification.
And that's a really good lead into having your assets have job descriptions. And that's very important with the asset cycle portfolio.
Yeah, so one thing that we're really big on at our firm is that we want to develop a plan. And with a financial plan, you've got various investments that have job descriptions. And it really starts with the lower quadrant of this graph here where you see short-term income. So maybe the first thing that you're going to account for is income in the early part of the plan. So maybe years 1 through 5, let's say, as an example. So you invest something that's very, very safe with very little risk to principal. So that's investing for short-term income. And then you move into medium-term or mid-term income. That might be years 5 through 10, or maybe it's years 7 through 11 or 12, depending on how we put this plan together. But here you're taking a little more risk, but not a lot more, because you're going to have to access this asset for income somewhere in the near future. Maybe it's 5 or, say 5 to 7 years. So you want to take a little risk, but not a lot, okay? So an example would be maybe you would buy a bond, an intermediate term bond, something that, might have some volatility, but with relative certainty, it's going to have a good stable rate of return for that period of time. Then, moving along the circle here, you move into the upper right-hand quadrant and you have long-term income. Well, so long-term income as defined here is maybe income that you're going to turn on maybe in 10 years, 12 years, maybe even 15 years, again, depending on the plan. Well, now, if you have growth of 10 years, you can do a lot of good things. You can do a lot of growth. You could take a lot of risk. There's products out there that you can set up for that specific purpose, is to generate income after the 10-year period of time. And then that's generating longer term income. So when you have job descriptions like this for every asset that you have, you can handle volatility a lot more because you have a plan. It's almost to be expected, because then if we go down into that lower right-hand quadrant, we have growth. And growth is money that you're either never going to touch, or you're going to need it maybe for emergencies, or you're going to need it maybe long term, way down the road. Maybe if you live long, you're going to access that. So now you have a plan that accounts for income now and income later, and along with that, you build in the expectation that there's going to be volatility in the market. You don't know when, you don't know to what degree. You just know that there's going to be volatility. So why do we say that? Well, because historically, if you look at time, there's always been a period where we've experienced volatility. Whether it's, we can go through the whole gambit over the last 40 years, whether it's Black Monday, whether it's the tech bubble in the 90s, early 2000s, whether it's the terrorist attacks, whether it's the financial crisis. We could go on and on and on. But those things, it's unreasonable for any retiree to expect there not to be some level of volatility in their financial world during their retirement.
And there's a saying that you have live on dollars and leave on dollars, and that is with the growth area and also the legacy transfer bucket. And that's why it's so important to do planning so you can identify
The
these.
planning is critical, Steve. And again, going back to this graph, and you see the legacy transfer bucket, that's the money, that's what you referred to as leave on money. So that's money that's going to go to your heirs. That's going to go to your family, your children, your grandchildren, your charities. That's your legacy. So if you take that growth bucket, if you don't spend that, that's going to end up in the legacy transfer bucket.
Yep.
So, so it's really important. It's critical that we account for all these. We didn't even talk about the protection umbrella. What's that, Steve?
Well, you have disability insurance when you work to protect your income. You might have long-term care insurance when you're not working to protect your assets.
Yeah. I really like this slide because it covers a lot of different things. It's really financial planning with one picture.
And
one picture.
And we do have some exciting things going to happen in 2024 with our Retirement Design Lab, and we're going to introduce a legacy planning seminar. And
yeah,
why don't we get into that?
Yeah,
just
it
a
is
little bit?
exciting. The Retirement Design Lab. We're going to take the show on the road. We're going to go to a couple different areas geographically. We have some things on the drawing board for that. Also for 24, we're going to do some legacy planning with our clients. That's important. It's so important to bring the planning down into the next generation. So that's really quite exciting. I also want to give a shout out. We have some really nice slides here today. So I want to acknowledge Cheryl Smith.
Great job
from our team. Who works behind the scenes to put these slides together? So it's always nice for us, Steve, to be in front of the camera, but a lot of this work gets done behind the scenes and behind the camera, and we have an awesome team. Yep. So big shout out to Cheryl for that today. The other thing that I want to mention is that our show, and of course we've been doing this now for 10 years. It's hard to believe. We're celebrating our 10-year anniversary. So we can be seen on the PCTV network. So it's thepctvnetwork.com. We also show it on our website, which is informedfamily.com. Or you can see it on YouTube. How about that?
Yeah,
so it's really becoming a streaming world, as my daughter likes to tell me. Everything's being streamed now, Dad. So we're not watching TV the way we used to.
It's not your father's TV anymore.
It's not your father's TV. That's for sure. I get reminded of that. But anyway, Steve, this is a great show today. I'm really happy with it, and mostly because of the message that it sends to the people that are watching on really the importance of retirement planning, the importance of taking care of all these things. Because you're going to live a long time in retirement, the longevity is going to be there. So you have to enjoy your retirement by taking care of the financial piece. So with all that being said, we're going to sign off. This is Financially Speaking.